Greetings to our viewers, our listeners across the length and breadth of South Africa, across the length and breadth of the African continent. My name is Kaya Buthelezi, the host of the Money Capital podcast. I'm excited today to be bringing you our guest. His name is Sphelele Mncube. He's the Senior Wealth Manager for Inkunzi Wealth Group, a very well-known financial services brand in South Africa. He's going to be taking us through today the hotly debated two-pot system, retirement two-pot system that has benefited millions and millions of retirement savers in the country. And again, one of the issues that we're going to delve into very deeply is to say, is this really benefiting the retirement savers in the country, or is it more benefiting the government in terms of the taxes that the government is collecting? So we're going to be looking at all of these issues with my guest, Mncube. And great to have you, and welcome to the Money Capital podcast, Mncube.
Thank you, Kai, for having me.
Excellent. If you could just, before we start, just tell us about yourself, where you were born and bred, and what was the interest in financial services as a wealth manager. There aren't many wealth managers in South Africa, black that is.
Yeah.
So we are quite excited to be talking to you. I mean, whenever I'm approached by financial planners and wealth managers, it's always our compatriots from other races. So I'm quite excited today to be talking to someone like you. Just tell us about your interest in this space and how were you introduced to it?
Thanks, Kai, for having me again. My interest in financial services started back in high school. I was one of the fortunate individuals who participated in what is now referred to as the JSE Schools Challenge. So basically what happens is the JSE goes around the country, recruits schools to participate in a program where they basically buy shares and trade shares, and the schools with the highest return then wins the competition. So that what sparked my interest in financial services at the time. Growing around in Newcastle, I never really had any exposure to the financial services industry because I come from a place which is still referred to as previously disadvantaged. So financial literacy is not one of the most common thing growing around that area. So that's what sparked my interest. And then naturally, I gravitated towards a course in commerce when I went to university in Pretoria. So that was just the beginning of my formal education in the study of finance. And furthermore, because luck follows you at times, depending how you position yourself, I was very fortunate to have joined Allan Gray in probably early stages as the first set of graduates that were hired by Allan Gray. So that further entrenched my love for finance and understanding of the world of investments, right? Because traditionally, what we considered finance at the time was someone was selling insurance, likely funeral or life insurance. But there was not many people that were helping people invest in the stock market. So that exposure really played a role in my future as far as my career was concerned. And with all that knowledge and understanding of investments and the capital markets, then it made sense for me to find myself in an organization that was helping people manage money instead of the focal point being insurance as we know it. So that's how I find myself at Inkunzi Wealth Group. It's been 11 to 12 years being in this organization. And I think we've done tremendously well for the people that we're servicing. And for me, I always say we're servicing families. So behind the ID numbers that we capture when we are meeting with clients, there's families that depend on the advice that we provide to those clients. So we have a huge responsibility for the clients that we serve to make sure that whatever advice we provide to them can ensure financial sustainability and create financial security, mostly at retirement. So our focal point has been retirement planning. And what guides that is, if you just think about most black households, there's probably two assets that one will have in their lifetime. It's either you own a big house that you can convert to an asset through selling that property, or it's either your pension fund, so ours is then to make sure that we help people understand how the pension fund system works and how they can use it in their favor to create generational wealth. So that's what I've been doing for the past 14 years as a business.
Excellent. So, but there's been the introduction of the two-pot retirement system.
Yeah.
If you could just elaborate for us as to what the two-pot system is and what has been the impact of it, as I would imagine your clients and many other members of pension funds in South Africa are actually withdrawing their pension savings as a result of the two-pot system, and what are its long-term effects on retirement savings. If you could just maybe start by unpacking what is this whole two-pot system is all about and its impact on your people, on your members.
Yeah, that's a very loaded question. So what I'll do is I'll try to answer it in 3 parts. So maybe let's start with the changes that have been happening in the retirement system. So our retirement industry has been going through changes from 2010 as an example. So we saw like a harmonization of provident funds and pension funds, making sure that it lessens the complexity of the retirement system. Because when you find someone who's a member of a provident fund and you find someone who's a member of a pension fund, their understanding and the treatment of their benefits is different, and that creates complexity when it comes to member education. So National Treasury has been at the forefront in making sure our members just have one source of information when it comes to the treatment of their pension funds and the rules governing the pension funds. So this has been 14 years in waiting. But I think what fast-tracked the process is obviously the COVID pandemic, because many people find themselves in a position where they were retrenched, were out of jobs, some lost houses, some their policies lapsed because they couldn't pay them, but they still had access to a pension pot. They didn't have access to a pension pot, but their pension benefits that have saved throughout their working lives, but they were unable to dip into those pension funds, especially when they are still employed. Because one of many ways for you to access a pension fund is through resignation or retirement, right? So not many people are willing to resign.
Or death.
Or death as well. Yeah, you're right. So not many people were willing to resign during that period. So they find themselves in a huge predicament where they had money saved, but they couldn't access it, right? So National Treasury has been consulting with industry players on how the two-pot system should be structured, or how can you create a system where our employees can have access to their pension funds. But keep in mind that we should create financial security for them at retirement, because 100% access is not really ideal for any economy, right? And on a personal level, if you're going to deplete your pension savings before retirement, it creates problems for you in the future, because there will probably be your only source of income when you retire, assuming you don't have any other alternative income sources, right? So last year, then we saw the implementation of the two-pot retirement system, right? There was still a lot of misconception on how the system works, and I believe there still is a lot that needs to be done. And I say that based on the work we've been doing on the ground, when we meet with various institutions and having employees tell us how the system works, so I think a lot of stakeholder education is still required, because they have a lot of influence on the decisions that are being made by the members on exit or on retirement or on retrenchment. So naturally, what we should have is a system where there is a benefit counselor, meaning that before you exit the system or before you withdraw from the two-pot system, it's ideal that you sit with someone who will counsel you on your benefits and just the implications of that decision, right?
So essentially, two-pot, if maybe we say it in isiZulu, amapoto amabili.
There are actually 3.
Oh,
it's not 2.
Oh, so it's no longer 2.
There's 3
So it's
pots.
3 pots. So one pot you can't access. That's the money you are saving until you retire,
Yeah.
You reach 65 if you are a man, you reach 60 if you are a woman,
Yeah.
and then you can access it.
Yeah.
The second pot is the one which you can then save on a monthly basis and then access on an annual basis.
Yeah.
So what is the third pot?
Okay. So there's 3 pots. I think for the ease of understanding, then it was made 2 pot. But there's 3 pots. So let's explain how these 3 pots came to be, right? So the system was implemented on the 1st of September 2025.
2024.
2024, so
Yes.
yeah. So there were savings that you would have made to your pension fund prior to that, right? So that is one pot,
Okay.
right? So that pot is referred to as the vested pot, right? So when the
It's
first
like all your accumulative
savings up
to that-
until 31st August, that's
2024.
2024.
Okay.
That's one.
It's called the vested pot.
That's pot number 1.
Pot number 1. All right.
Right.
Okay.
Right. From that vested pot, then based on the 2-pot system, a portion of that was moved to your savings pot. Right. So that pot is the one where most people,
Which is 30,000
yeah,
rand.
right. So that's
Or is
the
it
pot.
30% of whatever?
It's a third of what you had, but it can't be less. Can't be more than 30,000. So let's make an example.
Okay.
Right. Example, let's say I have R1 million in savings.
Okay.
Right. A portion of that was moved to the savings pot. But as a percentage, that percentage was probably 150,000.
Yeah.
But the rule says it can't be 150,000. The maximum
It can't be more than 30.
Yeah, the rule says it can't be
30,000.
150,000. It can only be 30,000 that gets moved over to this pot.
Okay.
So, as an example, if you had R1 million, you have 970,000 left in the vested pot, which
They
is
move
pot number
30,000.
They move 30,000
Yeah.
to what is called a savings pot.
Yeah.
So when the system opened on the 1st of September, you had 2 pots. Where does the third pot come to be now? The
And then
contributions.
from the 1st of September 2024, you could then take this 30,000
Yes.
in its entirety
Cash.
if you choose to do
Yes,
so.
if you
all right?
choose to do so.
Okay.
Then it gets taxed at your marginal tax rate. So your marginal tax rate is actually the rate of tax at which you pay your
Yes.
pays you an.
Which is it roughly 9,000? So
It depends.
Yeah.
Some guys could be at 45% tax rate. Some guys at 18% tax rate.
so what's the
So-
difference between the two?
The higher your tax bracket,
Or the higher, or
then
depending on how much you
obviously,
earn.
how much you earn.
Okay.
Yeah, so it's guided by that. It's not guided by the tax tables.
Okay.
So it's important that we explain that there's a difference between pay as you earn and the retirement or resignation tax tables. In this instance, we're using pay as you earn, right, which is informed by how much you pay on tax on a monthly basis.
So it becomes then a benefit to your salary,
it could be like a bonus.
a bonus, or
Yeah, because your bonus will then be taxed at your marginal tax rate. So that was part number 2, right? So now let's assume that on the 1st of September, I'm a member of a pension fund and I'm contributing like 1,000 rands, right? So a third of that will go into the savings pot, which is pot number 2 in this instance in our explanation, right? That's a pot that held the 30,000.
okay,
Irrespective if you withdrew the 30,000 or not.
or not.
So from 1,000 rand that you contribute, right, about 333 rands will now go to this pot, right?
Then the
This
670
creates a
was to be
retirement,
invested.
retirement savings pot.
Okay,
So that's the pot that you preserve until
they
retirement,
retire.
right? So let's go back and just talk about the savings pot now to say what does it mean, this pot that I'm creating. And it's very important, furthermore, that before I proceed, I talk about the vested pot, to say what does it mean, right? The old rules will apply to the vested pot, right? So if we can dive deep into that later. So if you're a member of the GPF, the old rules will apply, right? Assuming you know what the rules are. If you're a member of a private sector pension fund, the old rules will apply, right? So the old rules is
On the vested
on the vested pot.
Okay.
Which-
Meaning those rules are you can only take a third and then leave 2/3
to buy you an annuity.
to buy you an annuity.
Yeah.
All right?
So
So I think at a later point, please make the distinction between GPF members as well as members of private sector pension funds. Okay.
So the savings pot is just created for emergencies, right? So 333 rands gets invested on a monthly basis from the 1,000 rand, which was your total contribution prior. Because previously, from 1,000 rand, 100% of it would just go into your pension fund. That's it, which we now refer to as the vested pot. But now your pension fund contributions are split into two pots, which is a savings pot, and now this new pot, which is a retirement pot as well, right? The retirement pot will be preserved until retirement.
So now,
the 667, you won't be able to touch it. It's preserved up until you retire.
Retirement.
And when you retire, you'll now be forced to buy an annuity. An annuity is basically a product that pays you an income at retirement.
Okay.
So essentially what this means for the long term, every employee who's part of the retirement system will have an annuity solution at retirement. Because we have a huge issue of preservation in South Africa, where you find that people change jobs frequently.
And then I take the money.
Preservation rates are lower because they take the money and run. But now we are going to have a system where almost everyone will have access to an annuity-based product that will pay them an income when they retire. So that ensures like financial sustainability at retirement, right?
How? Advise, if you could just maybe, to interject there, but if you could maybe, I know I've heard of stories of teachers divorcing, resigning, taking the money, and then going back to the PESAF system again and contributing to the pension fund, and also nurses and so forth and so on. So is this what you've just explained to us now, these three pots as you are mentioning, is that the solution to that? So now our public servants in the main and many other employees in the country, they won't be able to do that as a result of the fact that we now have these three pots that is going to, create some stability in terms of financial services, savings in the country.
So there's two ways to think about this.
Yeah.
So the guys with a vested pot, which is people who had a pension fund prior to the 1st of September 2024, they will still have that optionality, because they can still resign from employment and access the vested pot. But assuming someone started working on the 1st of September, they will never have that optionality to be able to withdraw from the system and cash 100% of their pension benefit. They'll only be able to cash in the savings pot. And the retirement pot will then serve as an income-producing product at retirement. So ultimately, we're going to find ourselves with a pension system where most of us are sort of like obligated to buy an annuity-based product, and only a portion of our savings will be used for emergencies. But obviously, that has implications over the long term. Because when we started, you mentioned something very important regarding financial literacy, right? Financial literacy is like a sound foundation of retirement planning, because if you understand financial literacy, then you start to understand things like budgets, tax implications of these withdrawals, and compound interest as well, because it plays a factor. The longer you invest, the better you are, especially for members in the private sector. And that could also be somehow true for the members in the government space, because one of the factors that influence their retirement outcomes is the number of years they've been employed. But like you said, we'll chat about that a bit later on. So it is important for members to understand the implications of the savings pot, to say, what does it really mean for you if you're making these withdrawals over time, like we saw last year, where at least over 2 million submissions were made to withdraw from the system. It has implications definitely for the members over the long term.
And almost 43 billion rand has been withdrawn from the system. So the question is, how do members then replace that? or they can't replace it, what would be your view and advice to say this is how members, can replace this money which they've taken from the system? And how is it going to impact the system or the retirement savings in the long term?
So there's two ways members can replace this. So the first one is you can supplement your existing retirement savings. So you can do that through opening a retirement annuity. So it doesn't have to be with your employer.
Okay.
It could be with an third-party service provider, right, where you buy a retirement annuity to supplement your current retirement savings. Or number two, you can increase your contributions with your current employer to make up for the losses, that you incurred during this period. Because as much as we think of this in rand values, where people are withdrawing 30,000, it actually translates to a loss over time. Because if you take this money and you compound it over a 30-year period, like over a 20-year period, assuming one does these withdrawals on a yearly basis, we can then see the difference between what could have been and the amount that they will have at retirement. And those differences, I believe, will be very significant in the future as members continue doing these withdrawals. So those are one of the things that members need to think about broadly. To say, do I have a budgeting tool in place? Because some of these withdrawals are mainly informed by the fact that people are probably squeezed for cash. But is there a way that you can work around this through having a budget plan in place to help you understand how much of your pension benefit, if you're pressed for cash, you can actually withdraw? Because not everyone needs to make these withdrawals, let's be honest. But if the temptation does exist, I think you probably need to think about alternative sources of funding.
There's another big problem, especially in the government employees' pension space, of divorce, where we agree as a couple, we will divorce, access our money, split, and then go back to the system again. Have you encountered such cases, and what has been your interaction with those particular clients, and what would you say to them?
That's not the general feeling, but it's obviously very hard to prove the intention behind a divorce. If it's mainly because people don't access their pension funds, you can never prove that, and I don't think it would be easier for you to obtain that information, right? But literally, one thing people have to think about: when you are taking away from your pension fund, you are stealing away from your future self. That's it. Right? So if, let's say, you're going to end up with about 100 rands in your pension basket, you'll end up with less than that because of instant gratification. You were more obsessed about the current than the future. So the implications are far-reaching for most employees. And in the pension space, we usually talk about something which we call the replacement ratio. That says, as an employee, at all times, when you retire, you should make sure that you at least achieve to earn 75% of what you were earning before retirement. So if you're earning 10,000, at least strive to earn at least about 7,500
when I retire.
When you retire,
because
so,
the current rates they speak of a replacement rate of 19%. That is according to a study conducted by Credit Suisse. To say that 80% of South Africans retirees receive a pension, and the replacement rate is about 19% of their last salary. So there's a huge gap between my last salary as an employed person as well as what I earn as pension. So it's a big challenge.
Yeah, it's a big challenge. And the fact is, most employees will retire into poverty. So that's the fact that I think the two-pot system was trying to address as well. And ensure that at least when people retire, they have something to look forward to at retirement rather than being dependent on the state. And I think with our societal challenges that we have, where we have a high unemployment rate, it also puts pressure on financial dependency, right? Where you have households that at least about 4 people are dependent on one person. So you can imagine if a replacement ratio is under 40% or under 20%, and there's still about 4 people who are financially dependent on the pensioner, how much financial pressures that will create on that one person. So it is important, I think, again, to repeat, for the stakeholders to create tools that can help employees understand the implications of those decisions. Because unlike in medicine, if you consumed the wrong medication, I think it probably failed within a day or two. But with financial decisions, the impacts are felt far into the future. And it's very difficult for you to understand what your decisions will do for your financial security later in life. So stakeholders, I just urge them to create methods and tools that would allow employees to see in real time what the implications are of those decisions. Something as simple as for someone who withdraws 30,000 on an annual basis, and we project that into 30 years before they retire, and we apply a growth rate of, let's say, 9%, which is very conservative, and you show them in real time how much they stand to lose if they make that decision 30 times before they retire, and the difference between what they will end up with and what could have been. I think it's important that we nudge employees into making the right decisions. Because financial literacy remains a challenge.
So your word basically means, or what we are saying is that as much as the second pot is available, the savings, which I cannot access on an annual basis, what you are saying is that you advise people not to touch it.
Yeah, the pot should remain closed. If we say it like
okay.
So the pot should remain closed. There's no reason why anyone should entertain the optionality of the fact that it's available to them. I know in life there's obviously present circumstances, but under exceptional circumstances, I think one can consider, but they should also have a plan on how they should put back those savings into their pension basket. So if there's a withdrawal, I think they should always have a plan in place on how we can put those savings back into the pot.
One thing we advocate on this channel is the fact that we are unashamed about people making money. We are unashamed about people becoming wealthy.
Yes.
That it is very important people to understand money as a servant. So that you use money as your servant, not the other way around. So money must not use you as its servant. So it's very important that we then offer them empowering information and educational information that is going to make sure that they understand the power of money, but money as a servant for them. Now, with what I've just said, in the past 14 years of your career in financial planning, and in wealth management, how much you yourself have you made? Because it's very important as well that also, as you advise people, you also, put your money where your mouth is. So as you invest alongside your clients, you yourself, maybe, are you at liberty to disclose in terms of just one very good investment that you made and how much you made in that investment?
All right, I'll just explain this again. In 2 ways, right? As much as I've been in the financial services space for a period of at least 14 years, I just want to show and prove to people how much having access to the industry also doesn't give you an information advantage at times. I'm in my early 40s. I only started to see the benefit or the value of life insurance probably in my mid 30s. So maybe because I was never exposed to understanding its benefits. So one assumes that because I'm in the space and I work in financial services, probably this genius that understands everything and its workings, right? But that's simply because of the speciality nature of the work that we do. Just like a surgeon and a GP are different people, and a neurosurgeon as well. So there's a lot of mishaps one does along the way, simply because of an error of ignorance at times, and not understanding where one should be investing. So I think I've gotten better over the years, simply because I now have kids. So it's not only about myself. I think one gets pretty reckless if there's no consequences for the decisions.
If there's no structure, if there's no kids and the government in the house.
So that has gotten better with years. And what is gotten better with years is not actually investment as such. And I think it's creating a holistic plan for my financial life. So a holistic plan that looks into retirement savings, look into discretionary savings, look into risk products, meaning that if ever to get disabled or lost an ability to earn an income, at least my family will be taken care of. Or if I kick the bucket, that speaks to estate planning as well. So I think in that front, I've been able to do better than what I would have done almost 10 years ago, right? So ultimately, with everything said, the wealth that we create, I think most of it will come from the work that we do for clients. Being part of Inkunzi Wealth Group. So, because my financial success, I think, is tied to the financial success of Inkunzi Wealth Group. So, going back to answer your question, you'll probably have to find how much this business is worth. Then you'll know how much one has made over the years.
Yeah.
Right. So, but another thing I just want to mention is one thing that gets less spoken about is the errors of commission that we make as people in the financial services space. It's very easy for clients to see the mistakes that we make on their behalf when we invest money or we make decisions. But personally, I believe one of the errors that I made, which probably I can never quantify in rands, because no one will ever see it in my balance sheet, right, is not investing in cryptocurrencies or Bitcoin. And I remember this, some of the clients of Inkunzi Wealth Group will know there is an article I probably wrote about 7-8 years ago. And I was literally talking how bad that would be an investment. And almost 8 years later, I stayed with egg on my face, because maybe had I thought differently, I would have.
What informed you? Why would you say at that time cryptocurrency was a bad investment? Because I think the last time I checked, crypto is now, is it above $1 million, $1 million US per crypto? Or is it $100 million US?
Yeah. So maybe just.
So if you invested back then, people will be sitting like they will be multi-millionaires by now.
Yeah. But
it's one of those.
But it's one of those, I guess, like even if in financial services, the most successful people are right almost 6 out of 10 times. So you don't have to be right all the time. You just have to make sure when you're right, it's quite significant in terms of the returns that you generate as an individual. So the issue with cryptocurrencies and Bitcoin at the time was a question around the underlying asset, to say what is the underlying asset that will be able to generate value for individuals.
Can you just unpack that for our people?
It's very
if you invest or you make an investment, there must always be an underlying asset. Maybe if you can just unpack that so that people understand.
All right. So this, I think before we talk about this, we have to talk about asset classes, right? So when you invest, you have many assets that you can choose to invest in. So let's talk about what's really available to an average investor. You can put your money into shares. You can put your money into bonds.
That's JSE stock market.
That's stock
also
market.
global stock market. Yeah.
So you can put it offshore as well as onshore. So you can buy shares at ShopRite. You can buy shares at Woolies, right? You can invest in properties, right? So properties will be commercial property or even the malls as well. There's industrial properties now. Warehouses.
Exactly.
So those type of assets, you can invest in resources as well. So resources will be
gold, platinum,
iron ore.
Okay.
So, or you can invest in money market, which is a commonly used product where people invest cash and they earn an interest in return. So those are some of the asset choices that you have.
Bonds.
And bonds as well as an investor that you have access to. Now there's things like alternative investments where people are investing in things like your crypto, right? Which
So
is-
crypto falls in what is referred to as an alternative investment.
yeah, because
Okay.
there's not a traditional
Yes, not a
asset class
traditional
as we
asset
used
class.
to.
Yeah.
So some people are buying gold coins as an example. Some people are investing in bags, which is luxury bags. So those are alternative investments, right? So an example I think that most of your viewers will resonate with is think of a pyramid scheme, right? One of the ways that we usually say, how can you identify if something is a pyramid scheme, is always ask, where does the source of the return come from? And it's very difficult to locate that in a pyramid scheme, right? Ultimately, it's
So
because
in
there's
a
no real...
pyramid scheme, there's no underlying asset.
No, the money just comes from thin air, basically.
Okay.
And that's why it vanishes, like, sooner rather than later, right? So with crypto, those one of the most pertinent question at the time. And I think most people were wrong, So if you were to pull out reports of the most prominent investors, we were wrong, right, at the time. But there's also another...
Do you now invest in crypto? Do you have, do you invest your clients' money in crypto?
No.
And what has been
Our
the
clients
experience?
Our clients are retirees most of the time.
Okay.
So their risk appetite is not as great as that of someone my age. And they're naturally risk averse, so we don't expose them.
They want to preserve their
those
cash.
assets.
Yeah.
And as a business, we haven't ventured into investing on behalf of clients in that space. But if one were to ask me, is this something one can consider at this stage? If you have the risk appetite for it, I think you can consider. But obviously, go into it with an understanding that just like any other investment, what goes up may also go down as well. There's no investment where its birthright is always be going up. And I think that's one of the misconceptions that people probably have about, cryptocurrencies. And furthermore, I could even talk about Forex, where people just...
Yeah, in fact, I was about to ask you.
Invest in Forex. It's always
a hype around Forex in the country right now.
Yeah. So
do you advise people to invest in Forex?
I think it's understanding the reasons or your objectives behind investing in any asset. Your objectives, your risk appetite, and your investment horizon. I think those three factors should influence where you are investing. What's good for Peter may not be good for Paul when it comes to investing, because our investment objectives are different, right? So there's many assets that I probably would have invested into. I may have the risk appetite for those assets, but I don't have the risk capacity. And I want to explain this so people understand, right? Risk appetite means you want something at all cost, but do you have the capacity in case it goes against you to be able to manage the drawdowns that come from that or the losses that come from that? And we figure out that with most people, they don't have actually the risk capacity to manage losses, right? So that's why we find many fads in investments where one investment is good for 1 year and then the next year it has disappeared and a new product gets introduced. But what's interesting about financial services is a case of supply meeting demand. If people demand it, the industry will create it. That's how it works. Financial engineering is a very big part of our industry where products can be engineered, not for the benefit of the investor, but for the benefit of the industry at times. So in our business, we have this very simple principle that says anything that requires you to use an Excel spreadsheet to understand it, probably stay away from it because it's probably too complex, for you to understand.
Okay.
So most basic investments are great for an average investor. What will work in your favor is time, right? Time will work in your favor.
So these 100% returns, you don't advocate for people to go for those types of products and investments where you are promised 100% return, overnight.
All right. Let me answer your question in a joking manner, right? So if it is possible for one to achieve 100% return, I think what any smart individual will do I assume that a personal loan currently will cost you anything just under 30% annual interest. I will easily go to a bank, borrow money, invest and make 100% return on my investment, go back and pay 30% on the initial capital I borrowed. I can play that game up until I retire. So if the game was so simple, I don't think those...
Say it again. You go to the bank, you borrow money.
So here's an
then
example.
you pay 30%, and then
Right. I go to Eric.
Yeah.
He borrows me 100,000.
Yeah.
Which is a bank, right?
Yeah.
Personal interest on loans like 30%.
30%, yes.
So it means at the end of the year, I'll have to pay him 150,000.
Yes.
Right. But here's an investment that offers a return of 100%. So if I take my 100,000 from Eric, then I invest it here. With a year later, I would have 200,000. Then I go pay back the original loan.
130,000.
Pocketed.
Yeah. Then you keep 70.
Then I keep 70,000.
Yeah.
And I plant it back here. Then I have 140,000. Then I don't withdraw it because there's no loan obligation. So I'm 140,000.
Then it keeps on. Yeah.
280,000.
Yeah.
160,000. So any smart individual wouldn't be going to work if this existed.
So something like this, and therefore, in the real world, it doesn't exist. And therefore, people shouldn't be, when we are being promised 100% return, don't go there.
Nah. And most of the time, because there's legislation, I think what's important as well is for investors to understand that we are guided by rules and regulations, right? So the first thing is any person that offers financial advice or any person that offers a financial product should be registered with the FSCA, right? Which is previously was called the FSB, the Financial Services Board, which is a body that actually guides all our activities and puts the best interest of the investors ahead of those of the companies. So first things first is to understand if the person is accredited to even be selling what they are selling. That's very important. Just like we obsess, if our doctors went to Medunza or UCT or UKZN, I think we should have the same obsession with people that sell us financial products as well, which most of the time is not the case. We don't really obsess over their credentials.
Yes.
Right? And secondly, we have to look at what are the realistic returns one can expect from an investment. So when clients come to us and they ask the question, how much can I expect if I give you money, right? The most ideal thing to do is to look back at long-term history, right? And say, based on how the investments in which we invest on behalf of our clients have performed, what do we believe is a realistic return that you can achieve, right? So we, in our industry, we probably quote anything close to between 11 and 13%. And that's a very conservative number, right? But what works in your favor is a compounding factor. 13% may not seem much, or 11% may not seem much over a 1 year period. But if you compound that over a 10-year period, a 5-year period, 15 years, 20
because
years.
Because it's 13% over 13%.
Yeah.
So that's the compound effect, compounding effect.
So the simplest way to think about this, sizosebenzisa indaba yemfuyo, nenkomo ezu-10. Next year we have 12 or 14. Namankonyane akhulu nabo abe namankonyane abo. Compounding level.
That's compounding, yeah.
Right? So it's what's interesting about some of these things are inherent in how Africans view other things. But somehow, once we see them in the stock market as well as things that we can...
and exactly what I'm doing with my cattle in my crop.
It's the same principle.
It's the same principle that I can apply with my investments.
Yeah.
As the last... because I think we've run out of time.
Yes.
I think there's something important that we should be communicating to a young 25-year-old who's just starting out. I'm an accountant. I've just qualified at university. I'm 22, 23. What would be your word of advice to that young person who's just starting out in the corporate world. I'm earning 45K, whatever the case may be, and I'm putting so much towards retirement. And in order for that person to, let's say at 35 or close to where you say, you started being enlightened so that they are better off than Umzilankata here, what would be your word of advice to that person?
I believe the best way to think about this is in 3 phases. So there's 3 phases to your financial life. The first one is the accumulation phase. That's actually where you accumulate all the wealth that you consume later in the future. And the accumulation phase will probably last for the next 30 years of your working life, right? Because retirement, one of the most interesting thing about retirement is the fact that it's a fixed number, right? So a government employee, if you are the member of the SAPS, you have to retire at 60. That's what the rules say, right? If you're in the other departments at 65, so you can never change that fixed line, as an example. So the accumulation phase becomes a very important part of your financial life, right? And that's around 30 years of your life, assuming you start work at about 25, right? And then at 55, you've accumulated all these assets throughout your life. And assets will be your house, will be your pension fund, and any other assets you acquire along the way, right? So you don't want to miss that phase of your life. Very important. So a very structured approach to savings becomes very important. And what I'll advise is you start a basic investment, you automate the contributions to that investment, meaning that on a monthly basis, it goes out without any intervention from your side. And then what's left of that, it's your disposable income, right? As well. And you can also think about substantiating your savings through opening maybe a retirement annuity with a third-party provider, because it gives you flexibility as well to stop and start your contributions without any penalties. And an emergency fund, I think it's important as well. And what's interesting, as well, thinking about emergency funds, I think especially for people who were employed during the COVID pandemic, because they say every generation will be faced with certain tragedies that will influence their psychology of money, right? So it's quite interesting that we still find ourselves in an era where COVID showed us that there is really an importance for an emergency fund, yet given an opportunity not to touch the savings pot, we've literally somehow forgotten what COVID did to us in the absence of an emergency fund.
Yeah.
So I think, those psychological impacts are probably less felt than they are maybe with previous generations that experience high inflation, high interest rates. Because my mom used to say, it's collect on his phone, because she was probably a generation that experienced high interest rates.
Yes.
So they hated debt with every part of their existence. So I think our generation will have to go through the same cycles. The next phase is the consolidation phase. So that's literally now where you consolidate all the assets that you've gathered all along these years. You want to preserve what you have, right? So if you have 5 years to retirement, you want to make sure that you create a solid foundation for your
But in all of this, I hear you are saying you must have a structured, financial, planning system. But there's pressure. There's the Instagram pressure.
Yes.
I want to travel. I want to do this. I want to do that. I want to spend money.
Yeah.
How do we balance between the two? The kind of lifestyle that is being, flaunted on social media and financial discipline towards my savings goal and retirement goals.
I believe it's striking a need between your needs and your wants. I think you have to understand your priorities. So one of the things that are important that we always look at is your fixed expenses in life will probably contribute 60% of your salary. So where you stay, what car you drive, where your kids go to school, where you probably eat out, those expenses will drive a huge part of your disposable income, right? So we've seen it even with our clients, where you find someone who's probably in the top 5% as far as earnings are concerned, meaning that they earn anything above 40,000, yet their lifestyle is designed in a way that they don't have sufficient disposable income after paying for their fixed expenses. So I think your lifestyle choices will really determine where you end up as an individual, right? That's one thing that you have to think about when you want to think about your financial future, where it looks, right? So you have to be tight-fisted, I think, over the short term to create a foundation that will allow you flexibility later in life.
I think that was a great point to end it.
Okay. Something I add before this.
Okay.
It's just the value of financial advice. Maybe that, I think in closing, we can add that. And the reason why I say this, because a lot of information that has been spread regarding even the toolpot based on our engagement with clients, it's so much misinformation because we are in these, I'm in these Facebook groups. I also joined some WhatsApp groups, not because I want to be part of it, but for us, it helps shaping our message in misinformation. So I think that because we also have, I'm recording, we're just having a conversation. If brand here, because Owen was doing a lot of work, Power FM previously, and Kai FM, which is the Clever Blacks radio stations. So there was this specific thing that you probably need $1 million and up to even chat to us. So another misconception, people think for me to engage with a financial advisor, I need to have millions, I need to have hundreds of thousands. But it started with just a basic plan, of your life, especially for people that are employed. Because when I started working, I only invested money with Alan Gray. I didn't know what insurance was. I hated brokers. I just thought brokers was just guys who are running around with.
We're not going to mention Alan Gray because they're not paying us anything.
No, I'm making an example.
Okay, yeah.
Wow. So I didn't know. So there was no retirement plan, especially us with defined contribution fund. I'm earning so much. How can I substantiate those savings? I didn't know. I was just allowed the employer contribution and my contribution to go, and that was it. I had high likelihood of probably getting disabled and all these other things because I was still very young. We go out, we drink, this kind of thing.
Yes.
So I didn't have insurance, not even life, something that could cover disability, dread disease, all those kind of things. I didn't have those things. When I bought my house, the guy at the bank said, you should take life insurance against the house. I said, screw you. You are lying to me. I didn't know that it was, So had anything happened to me, my house would have just gone.
Yes.
Basically. So we are one of those because for me, I never had someone creating a plan. There's always people selling me products. There's never a plan.
There's no plan. It's just products.
Products that are being sold. So I think ultimately, to see if
to have a plan.
Yeah, plan. But work with someone who's credible.
Yes.
Not an insurance broker, not a funeral broker who presents himself as a financial plan. Because the industry is a lot of salespeople where
I think that's
solution-driven people.
Yeah. I think that's a very nice way to end it.
Yeah.
In fact, it's a point that I wanted to make, but I think we've run out of time. But it's a great point to end it, but I think we've run out of time. We have millions and millions of our people buying funeral cover. They have 3-4 funeral policies, but when you look at their investment strategy or investment plan, there's nothing. So what we want to say to people that to be financially secure, it's possible, as we have heard from our colleague Umzilangata Sphelele Mncube, Senior Wealth Manager of the Inkunzi Wealth Group, that it is possible, ladies and gentlemen, it is possible to be financially secure. It is possible to have a financial plan. Don't just buy products, just because they are being pushed down your throat. But you must actually have a financial plan. You must start very early because you need time on your side. That's very important. That the get-rich-quick schemes are not going to take you anywhere. So That's me, Kaya Butelezi, mfana wasesiqhawini kwamashu, your host of the Money Capital podcast. Don't forget to subscribe, follow us on our different social media platforms. It was great chatting to you. Thank you very much for your time, Zilankata.
Thank you.
Until we meet the next time, cheers. Bye-bye.